channel, guys. Let us subscribe to the YouTube channel and stay tuned to all the videos. Okay, as well as starting to prepare for exams, we'll continue moving on together. Okay, so we're trying to look at what monetary sector are. Of course, I believe by now we looked at what macroeconomics is. We also differentiated it from macroeconomics. We looked at unemployment. We know what unemployment is. We now looked at government sector, which we talked about how the government earns income and spends the money that it earns as the income or the revenue. Okay, we now are going to try to talk about the monetary sector while we talk about how the banks or the highest institution gain or have that money. Okay, we are also going to talk about, okay, let me just go to the outline so that you guys can see what I'm talking about. So we're going to define what money is. We're going to talk about the functions of what money is. We're going to talk about the characteristics. We're going to talk about central banking. We're also going to talk about how banking creates money. I mean, banks create money and how the monetary policy acts. Okay, so we can start with the definition of what money is. Okay, so we're going to dive in. So money is simply the asset. So money can be simply defined as an asset that is used as a medium of exchange, a store of value, or a standard deferred of payment, and a unit of an account. To simplify this, or to just make it in simpler ways, money is simply any asset that is used as a mean of exchange for goods and services that is acceptable. So money should be acceptable. Something that is accepted as a mean of an exchange for goods and services is what we're calling money. Money is not necessarily supposed to be what we know as money, as those papers and everything, quarter, what, coins and everything. Money is anything, any asset that is simply used as a means of an exchange for goods and services. As long as someone that is consuming and that is producing, both of them agree on the agreement, then whatever they are using as a mean of an exchange is what we're calling money. Okay, so we can as well talk about the functions of money, but before I do that, I want to talk about or specify something. Money, most of us in our daily life, we use money wrongly by putting it as income or the wealth of someone. These are two different things compared to money, or they are away from money. So most of us, we say this person gets this much money by the end of the month as their salary. This much person gets this much as their pocket money. This person gets this. So we are not necessarily supposed to put money as income, because it is not income, it is an asset. As well, we say this person has this much money, this person has that much money, so we're simply putting money to be income or wealth, which is wrongly interpreted or interpreted. Okay, so moving on. Money, I'd already explained what money is. You can refer back to the video. Okay, so moving on to the functions of what money is. We know that the same definitions that I put at first, I had mentioned to say money is used as a medium of exchange, store of value, and standard deferred of payment, and the unit of accounts. So now, going deep in it, the store of value. What do we mean by the store of value? So money can be used to stand for the purchasing power of someone. Money can simply tell you to say, if you have this much money, then with the money that you have, you'll be able to buy that much of the quantity of the good that you want. So the more money that you have, the more purchasing power that you have. Okay, it stands as the store of value. So money can as well stand as the medium of an exchange. What do we mean by that? Money will be there as uh, it will give you the ability to purchase goods and services that you want, because it is going to be, it is accepted as a mean of an exchange. Okay, so we are going to find that the government usually issues to say money is what we're going to be using. The kwacha, the currency that we have now, is what we're going to be using as the means of an exchange. So money is going to be basically the mean of the exchange that we're putting there. Okay, so without money, we would be using barter exchange. Okay, what is now barter exchange? Barter exchange is simply the, you know, we come to a part where if goods and services are consumed, or if a person wants to consume something, they must have a good that someone else is interested in. And that thing must be, if they want to get a phone, for example, let me say, if I have a phone, then I want to get a port from you. You are interested in my phone, I'm interested in your port. Then we're going to exchange those two things, or those two commodities, because you are interested in what I want, I'm interested in what you want. That is barter transaction. But that seemed to be wrong, because it is unnecessary that you have to get more, because you might get something that is more valuable than what you are giving me. So that is wrong. That's why money is used now, because it will tell you the actual value of something, which brings us to the part, or this unit of account, the value of a thing. So money is going to account for the value of a good or a service that you want to consume. Basically, you'll be like, okay, if a phone costs 100 kwacha, then you must get that phone at 100 kwacha. Okay, if the port costs a 10 kwacha, then you should get the phone at 10 kwacha. It's not supposed to be like, if you want a phone that costs 100 kwacha, you get something that is lower than that just because you want a port. No. So that is all about money. Okay, so now what do we mean by standard of deferred payment? So money can as well be, can be as well as be a standard of the deferred payment. You go to someone, you promise the person to say, I'll give you later, give me what you want, give me what you have, I want that, what the thing that you have, I'll give you the money later. So it means that you can credit, I mean, you can lend money from someone, I mean, you can borrow some money from someone, expecting to give that person some other time. So it means that that same transaction, it's a transaction that is there. As long as I've promised you, the same promise is what we're calling money there. As long as I've promised you, I've already paid you. It doesn't necessarily mean that I have to give you the money. Okay, moving on. So money can be measured. Okay, money can be measured. How do we measure money? We measure money in different ways. Okay, we measure money specifically using what we call as the monetary aggregates. These monetary aggregates act as a system on telling us to say, for you to have this kind of money, how fast are you going to use the kind of money that you have? That's all about the aggregate, the monetary aggregates. Okay, so you first have to understand what we mean by liquidity. Okay, liquidity will tell you to say, with the asset that you have, remember that money is being defined as an asset that can simply be put in, an asset that is acceptable, or an asset that is accepted as a mean of exchange. So now we measure money because we want to know to say, that asset that you have, how fast can you use it to convert it to money? How easy it is? What cost are you going to get from exchanging that thing that you have? Um, yeah, how fast is it? Okay, so that is about liquidity. You also have to know that you are certain about you doing the transaction, from changing the thing that you have into money. Okay, so that is about liquidity. It's just how easy, how fast you're going to exchange the asset that you have into money. Okay, so we have goods like, I mean, we have things, assets like money itself, checks, deposits, bank deposits, mobile money, balances, electronic balances, and all those things. Those things can be used as money, and most of them are liquid, highly liquid. For example, cash. Cash is very liquid. It means that it can just be used just there and then. If you have money there, you just go in the shop and you get what you want. Okay, we have current bank accounts, the money that you have in your bank accounts, like mobile money, the bank account in your Zanaco, and they give you the hell's be a person in drama school, all that money that is there, you just withdraw whenever you want to withdraw. So that's the thing that we're talking about here. Okay, we can as well talk about the savings. Savings are actually fairly liquid because you can withdraw them later, but of course they're not as liquid as the cash that you might have or the current bank cash that you might have in your bank accounts. Then you can as well have shares. So shares can as well stand to be part of the money, but they are less liquid because you find that it is hard. You cannot just convert shares there and then. You have to look for a buyer. The buyer buys your shares, you wait for some time, then you convert it into money. And then as well, you can have houses, things like houses, cars, stuff like that. Those things are less or relative in liquid. What we mean is this: it is hard for you to just change. You can't get a house and you go in the shop and say, "Nifuna lollipop, nifuna biscuit, amene mukugulisa, I'll give you my house." That's impossible. Money is something that people are going to accept there and then. That is the definition for money. So houses and all those things cannot just be accepted there and then the way they are, unless you sell them, you look for a buyer and all those things. They actually take consideration. Okay, so that is about the liquidity of the monetary aggregates. Let us try to watch the next video for. Okay, let me just continue in this same video. Sorry about that. I'll just finish this part and we'll cut the video, then watch the next video for the next lesson. Okay, so the monetary aggregate. I mentioned to say there are three monetary aggregates. Okay, we have M1, M2, we also have M2 plus slash M3. Okay, so you have to understand how these things work. The M1 monetary aggregate is simply the narrowest aggregate, which means that this is mostly liquid. It means that this, whatever things that you have, whatever assets that you have, can be easily be used there and then. There is no need for you to convert it, you get it, you take it where elsewhere, you sell it, you do it, then you use it. No, you can. It simply means that if you want a good, you get whatever money that whatever asset that you have, you go in the shop, they give you what you want because they are able to accept that money there and there. So that is about the M1. So money like the hard cash, currency held by the public, that the same currency that you have, etc. The demanded money, of course, the deposits, all those deposits that are demanded. So demanded deposits are simply deposits whereby if you get money, you go to the bank, you put money in your bank account, you can demand it whenever you want, right? So you can get it whenever you want. Those are highly liquid. Okay, they can simply move from an asset to money and you use it there and then. And then M2 monetary aggregate. So here you have money that is like in a form of savings, right? You find that you put money in a savings bank, you say, okay, I will withdraw this money within this period of time, expecting interest, right? Although from to you people that like depositing money in your pantumba, you don't even get interest. But otherwise, yeah, something like that. You would get money, you put it from a pantumba, you get money, you put it per something like banky. All those time they'll give you a period of time, then you accept the money in that period of time, right? Something like that. But this money cannot just be used there and then, right? Because yeah, you have to wait for that period. But you can withdraw it the moment that money comes, right? It has some consequences. If you want to withdraw it as before the due date, you find that maybe they charge you for the penalty. But if you want to wait, then you wait. So it means that it might take time. And then we have the last one, which is the M2 plus slash M3. This monetary aggregate is simply the kind of money aggregate that has this one involves M1 plus that plus the other assets that are like money, like, right, that I had already explained. And then here this one is going to involve M2 that involves M1 plus money like investments. So like the deposits in other institutions that are non-financial institutions. Okay, they can be either institutions that are credit unions or other non-financial institutions. Okay, so you're going to find that maybe if you get a 10,000, you invest that 10,000. So that 10,000 is going to be part of the monetary, monetary aggregate for M2 plus slash M3. What this means is that you cannot just get that investment there and then. If you invest, you expect the investment after some period of time. Investments are something that you have to wait for a long period. Okay, it's not necessary that for a long period, but you have to wait for some time. Let's say maybe a period of 5 years, period of 2 years, period of 1 year, all those. So that is about the monetary aggregate. Okay, like I mentioned, I'm going to cut the video from here. Let us subscribe to the YouTube channel and stay tuned. I'm creating another video on the second part for characteristics of monetary aggregate. As you can see, we have just cutted 9 slides, while remaining with 50 out of 54. So let us continue watching the videos and subscribe to the YouTube channel. Share the links with your friends. Thank you.